In this lecture, I would like to say about the depreciation of Indian currency and few words regarding this concept. And if you consider today, that is 30 March 2026, the Indian currency in respect of US dollar is 95.28. Okay, so downward tendency and number of apprehensions were there regarding the depreciations of the Indian currency. For a perspective of the downward trend or extent of the Indian currency, you have that it depreciates near about 2.5 to 3% per year. And 31st March 2025 to 30th March 2026, there is a near about 8.45% depreciations of the Indian currency. And also, if you consider the today's rate, then you can find the depreciation is more than 10%. So naturally, you have an understanding that that there is a depreciation of Indian currency, and as an emerging economy or developing economy, India mostly depends on the import of goods in compared to export. As a result, there is a pressure on the exchange rate, and currency depreciates. This is the main base of depreciation of the Indian currency. So, but I would like to say, if the situation is like this, then how does it impact you? So there is a impact on your investment. For example, in the bond, you can invest in the I can say there is a equity you can invest, and also you can invest in gold. So there are so many options, but a good and rational and risk-averse investor always try to focus to minimize the risks, and as a result there should be a diversification in the portfolio. So portfolio should be diversified. Now the how far this depreciation, I would like to say that how far this depreciation will affect your investment. So investment may be affected in the sense that return will be low. I would like to say that there will be a minimum effect on your investment if you focus very carefully. Look, investment, does not have any direct impact on your equity, and but a negative sentiments there you can find in the market just because of the depreciation of the Indian currency. And why this affects little in your investment attitude. As I have mentioned that this this depreciations of the Indian currency does have some negative impact on the sentiment of the market, but you should remember in your mind that market it is not only affected by the depreciation of the Indian currency. There are so many factors, and actually it is affected by the confluence of those factors, and the trend you can find as a result of cumulative effect of these factors. So, if you find the correction of the market, then you find there are shifting of foreign investments from Indian economy. That is, I can say that the international portfolio investment. And also there are other factors such as the oil price increase, and and this oil price increase is another reason. So number of economic factors are there. Only if you say the exchange rate depreciation is the main reason of getting low return from your portfolio, that would not be correct. Weaker currency actually affects the price of the imported goods. As a result, the price of the imported goods rises, and that reflects in the imported inflation. And for example, the oil is exported from outside of India, and it gets a conversion of INR, Indian rupee. And as a result, if the Indian currency weakens, then the price of the oil will increase, and as a result, there is a inflation all over the economy. Okay, all over the economy. And not only this inflation affects the each and every section of the common people, but it directly affects the interest rate. Interest rate is much more related with the inflation. And if you invest your money in the bonds, then bonds get mostly affected just because of the inflation, and as a result of inflation, the rise in interest rate. But if you see the equity market or equity, then this inflation has little impact on the equity, because as I have mentioned earlier, that the equity market is a confluence of number of factors. So this is the matter. But if you consider the inflation, imported inflation movement or trend, upward trend, then the weakening currency is responsible. If you invest your money in equity, then you should not be much more care about the investment, but you should be conscious. There is also a role of expectation of inflation. And if you consider the RBI's role and in this situation, then you can find that the RBI is try to control the weakness of the Indian currency by selling deposited dollar in the market. And they are expecting that it will be near about 94, 95 per dollar in the coming future, and much not more. So if there is not a situation, something negative happens in the coming future, and you can say it is very very unfortunate, then the weakening currency will affect your investment. And if we diversify your investment in such a way, for example, if you invest your money in gold and foreign investment and in foreign portfolio, foreign equity, for example, mutual funds in USA, and and you are investing in such a way, and and you follow this path. For example, you have 1 lakh rupees and you try to invest, try to make your portfolio in such a way that the 10 to 15% or maximum 20% in gold you can invest, when you not more than 20% or 50%, because gold is just a non-performing asset. There you should not expect much more return from the gold. So a major part of your money should be, that is 60 to 60%, 60% should be invested in the equity market and mutuals, or the mutual funds or the equities. So, and that should be abroad. Your investment should be abroad, because if you invest in US market, then your money will at first is converted into dollar, and then again when you cash back your money, then also your dollar is converted into rupee. And if during this time there is a weakness of the Indian currency, and Indian currency weakens, then you will get the benefit from investing your money abroad. And also you can invest a little part of your money in the bond. So weakening positions of the Indian currency, has some effect, no doubt, in the investment, and that can be minimized just by diversifying your portfolio. So, on the other hand, if you consider the expenses, as I have mentioned, that there is a impact of weaker currency on the inflation. So weaker currency, and also there is imported inflation, and and this mostly affects the life of common people. Now, if you consider the direct impact of this weaker currency on your daily life, and naturally a word comes in your mind, that is the expenses. As purchasing power of rupee comes down progressively, and this deterioration of the purchasing power of currency, there is a reason, that is the weaker currency, and this is not in your hands. Apart from expenses, you should invest abroad, and this is the understanding. How far the Indian economy is resilient, that matters. And so sustainable finance, the concept emerges here. So, seeing the trend of weakening of INR, Indian rupee, I would suggest that not have much more to control the depreciation, and so there is only one way. You should diversify nally, that is, you are investing in different type of assets within the country, but also you should invest abroad.